You sit down at your desk, the markets are open, and you feel the immense, suffocating pressure to do something. You scroll through charts. You force an entry on a setup that's just good enough. You exit early. You re-enter. You are spending 6, 7, maybe 8 hours active in the market, and at the end of the day, you realize your activity did not generate profit. It generated noise, stress, and losses. Your success in trading is inversely proportional to your activity level. The more trades you take, the more you erode your statistical edge. The less you trade, the more you protect your psychological capital and your equity curve. This is the counterintuitive truth. Trading less doesn't make you lazy, it makes you rich. It fundamentally shifts you from being an emotional, chaotic participant to a ruthless, selective predator. This video is going to expose the deep psychological traps that make you addicted to action and give you the 3 non-negotiable rules for embracing the power of inaction. We will redefine your job from constant market participation to one of strategic, profitable stillness. The first trap is the dopamine tax, which forces you to adopt the casino model of trading. Here's a lie you tell yourself. The feeling of entering a trade is a productive action leading toward profit. The psychological truth is, that feeling is a rush of dopamine, a neurological reward for novelty and risk. Waiting delivers 0 dopamine. Your brain, being a reward-seeking machine, subtly pushes you toward B-grade and C-grade trades simply to get its fix. Think about a slot machine. The reward isn't the jackpot. The true addiction is the anticipation of the next spin. The market, when treated as a constant source of action, becomes your slot machine. The dopamine tax is the price you pay, usually a small loss on a non-ideal setup, for the brief, addictive pleasure of pressing the button. A professional trader views capital allocation the way a venture capitalist views investment. A VC doesn't invest in every startup they see. They invest in 1 out of 100, waiting months or years for the statistically perfect alignment of team, market, and product. Why? Because their reputation and capital depend on maximizing the expected value of every dollar deployed. Your trading account must be managed with the same scarcity mindset. You are not a daily gambler. You are a venture capitalist allocating capital to high expected value opportunities. Here's the fix: the quality over quantity framework. You must consciously rewire your brain to associate protection of capital with a reward. Before you sit down, write down the phrase, "My job is to preserve capital until a statistical edge appears." Set a timer for 60 minutes. If you go 60 minutes without taking a trade, reward yourself mentally. Perfect execution. I protected my capital and I maximized my EV. If you take a B-grade trade, you must impose a clear, non-monetary penalty, like closing the charts for 2 hours. You are training your brain that discipline and inaction are the new dopamine hits. The second trap is the expected value illusion, which leads to the catastrophic phenomenon of edge dilution. Here's a lie you tell yourself. Since my A-plus strategy has a high win rate, say 65%, taking more trades, even lower quality ones, is mathematically better. The psychological truth is, this is the core mathematical error of overtrading. Every single trade you take that is not your A-plus setup directly dilutes the overall statistical performance of your entire system. Imagine your A-plus setup gives you an expected value of plus $500 per trade. Your B-grade setups, the ones you force out of boredom, actually have an EV of minus $50 per trade. If you take just 2 B-grade trades for every 1 A-plus trade, you are dramatically shrinking your profit potential. You gain $500, but you lose $100. That's a 20% erosion of your edge for the day, all driven by impatience. The market only offers a handful of true high-probability moments. The rest is randomness. When you trade randomness, your edge, the thing that makes you money, approaches zero. Here's the fix: the daily trade quota and the scarcity principle. You must enforce scarcity on your execution, treating your A-plus setups like gold. Set a maximum daily trade quota, non-negotiably, of 2 to 3 trades, regardless of the outcome. Once you hit that quota, you are done. This rule forces you to acknowledge that the market only gives a handful of truly optimal opportunities per session. When you have a limited quota, the psychological dynamic shifts. You stop trying to find trades and start waiting for them to present themselves. You become a selective predator, not a frantic scavenger. This scarcity mindset forces you to only deploy capital when your statistical conviction is at its absolute maximum, protecting your mathematical edge.
The third trap is the market presence pressure, which is driven by the crippling fear of missing out, FOMO. Here's a lie you tell yourself: if the market is making a huge move, I must be in it, or I'm failing as a trader. The psychological truth is, this pressure stems from a primal fear of being excluded, and it's amplified by the illusion that success is tied to constant market involvement. When you see a huge trend you missed, the emotional pain is not just about the money, it's about the regret of the missed opportunity, which instantly triggers a rush to take the next impulsive trade. Elite traders understand that market noise is simply the cost of doing business. Their job is not to be a participant in every single trend. It is to be a selective architect who enters only when the conditions align with their plan's blueprint. The random price action you missed was not your trade. It was someone else's loss. Here's the fix: the set and forget protocol for inaction. You must define clear periods of required inactivity to physically and psychologically break the link between presence and profit. Define a strict no-trade window during the choppiest, low-volume parts of the day, e.g. the midday range. During this window, you must close your trading terminal entirely and only monitor the market on a high time frame chart, like the daily or 4-hour. Furthermore, adopt the set and forget approach. Once your A-plus trade is placed and the stop and target are set, you mentally disengage. Do not micromanage the trade on a lower time frame. You are training your mind that the trade is now the market's problem, not yours. This shift from constant management to quiet observation is the ultimate power move. The most profitable action you can take is often the deliberate act of inaction. To solidify this concept, think of yourself not as a frantic market participant, but as a professional fisherman. The amateur fisherman throws their net into the water constantly, pulling it up every few minutes because they are desperate for a catch. They spend all day working hard. Their nets are full of weeds and small, unprofitable minnows, and they are exhausted by evening. They are trading constantly, but they are consistently losing money. The master fisherman studies the tides, monitors the weather, and researches the migratory patterns. He only casts his net once per day, in the precise moment and in the precise location where the probability of a large, high-value catch is maximized. He spends 90% of his time waiting and preparing, and 10% of his time executing. He works less, but he harvests exponentially more profit. Your A-plus setup is the precise location. Your discipline is the patience to wait for the perfect tide. If you're trading constantly, you are paying the dopamine tax and diluting your edge. You must choose. Do you want to be the tired amateur or the rich, selective master? All right, let's wrap up this deep dive into the power of inaction. You now know how to combat, number one, the dopamine tax, which is fixed by the quality over quantity framework. Number two, the expected value illusion, which is fixed by the daily trade quota and scarcity. Number three, the market presence pressure, which is fixed by the set and forget protocol. Here's a key takeaway. Your trading success is measured by the quality of your decisions, not the quantity of your actions. Stop giving your hard-earned capital away in search of a dopamine rush. The less you trade, the more you protect your edge, and the faster your equity curve will grow. If this framework is the edge you needed to stop overtrading and start making money, hit the like button and subscribe. See you in the next one.